Imagine opening up your investment portfolio and seeing a massive 40% annual return. In the high-stakes world of investing, a number like that usually sounds like a complete scam, or maybe a 1 in a million lucky streak. But this wasn't just some lucky guess on a hot tech stock. Legendary investor Joel Greenblatt actually pulled off this massive 40% return for 20 years straight with his Gotham funds. It's literally one of the single greatest track records in Wall Street history. It completely shatters what most financial advisors tell you is actually possible. So let's dive right into this explainer. We're looking at the secret blueprint to the trial of patience. It's a remarkably simple, numbers-based system, but executing it tests the absolute limits of human patience. Now, you might be wondering, how do you beat Wall Street professionals at their own game without a fancy finance degree or a massive team of analysts? Well, Greenblatt designed this strategy to be simple enough to explain to his own kids. It relies on one core idea: finding fundamentally good companies at bargain basement prices. Think of this as your professional guide, tailored specifically for everyday retail investors. Let's break down metric 1, decoding earnings yield. Greenblatt solved this whole investing puzzle using just 2 core metrics. The first is earnings yield. In everyday terms, this just tells you how many dollars you can expect a business to make per year for every single dollar you invest in its stock. It is the ultimate way to spot a bargain. You want to know your investment is actually generating cash. Let's ground this with a real-world example so the math makes perfect sense. Imagine a company, and over the last year, it earned exactly 85 cents in pure profit for every single share of its stock. Now, if that stock costs $17 to buy on the open market, you just divide that 85 cents of profit by the $17 price tag. That simple math gives you a solid 5% expected return on your money. The rule here is super straightforward. The higher the yield, the cheaper the stock is relative to the cash it makes. You are basically hunting for businesses that are severely on sale. Moving right into metric 2, mastering return on capital. While that first metric helps us find cheap stocks, return on capital proves if a company is actually, good. It measures operational efficiency. It shows exactly how much of your invested money the company turns into actual after-tax profit. Because buying a cheap stock is worthless if the business is just burning cash, right? You need a company that actually puts its capital to work. For example, think about a manufacturing business that drops $500,000 into building a brand new steel production plant. As an investor, you need to know if that was a smart move or a massive waste of resources. If that new plant produces $200,000 in profit over the year, that is a phenomenal 40% return on capital. That's top-tier efficiency. As a rule of thumb for this strategy, anything over 25% is incredibly strong. It means the company is a compounding machine, reliably turning small amounts of money into giant piles of cash. Now for the really fun part, the 2-factor ranking system. Here is the absolute aha moment where we bring these 2 pieces together. You take all the thousands of stocks in the market and you rank them on both of these lists. So, if a highly efficient company ranks number 153 in return on capital, but it's heavily discounted and ranks number 1 in earnings yield, its combined score is 154. We are literally marrying cheap with good. The lower that combined score is, the better the opportunity. From there, you just follow a totally unemotional, mechanical loop. You calculate the metrics, you rank the market, you buy the top 20 to 30 stocks, and here is the absolute secret sauce. You hold them for exactly 1 year. No matter what the market does, you hold. Then, after 1 year, you sell and repeat the whole process again. Which brings us to the patience paradox. This brilliant system leads to a totally fascinating paradox. If it's really this simple, why isn't everyone a millionaire? Look at the math right here. $10,000 invested in this exact strategy in 1988 mathematically grew into $1 million by 2009. The numbers are bulletproof. Yet, almost nobody actually pulls this off. The irony? Highly paid Wall Street pros usually can't execute this. Their clients constantly demand instant quarterly profits. If a manager underperforms for a few months, they get fired. But everyday retail investors, like you and me, we have a hidden superpower. We have the luxury of long-term discipline. We don't have a boss breathing down our necks for quarterly reports. And that independence matters. Because here is the painful truth of this blueprint. This strategy actually underperforms the broader market 1 out of every 4 years. Sometimes it lags for 2 or 3 years in a row. True consistency is incredibly boring. Surviving those prolonged dips without panicking or selling, that is the ultimate trial of patience. As financial author Carl Richards brilliantly puts it, the toughest thing about investing is that you have to be lazy. As humans, we are wired to tinker. We react to breaking news. We try to outsmart the market. But with this system, doing absolutely nothing is the most profitable action you can take. So, as you look at your own financial goals, the final question is this. Will you give in to the pressure and chase the short-term thrills of Wall Street? Or do you have the unshakable discipline to endure the boredom for long-term millions?